Okay, so welcome everyone. This is Alexandra Dest. I'm the CEO for those of you who may or may not know me of Willow. And with me today is Gabby, who is going to be basically guiding this presentation for us. Gabby is we call her our Jacqueline of all trades. So she seems to know how to do a little bit of everything for us and keeps us sane, which is, very important. And also with us is Rachel. So many of you should have had the opportunity to meet Rachel. She's our Director of Client Services. Couldn't ask for a better team member to take care of all your needs. She's really got, we think, number one. And then, of course, Paul, who has been now promoted to Managing Director and also co-owner with me now of Willow. So anyway, what we're going to do today is we're going to be introducing our newest DBA, which is Willow Crypto. And before we go forward, we're just going to let Rachel do a little bit of our disclaimers for us.
Sure. All right. So before I dive into disclaimers, I will say that there is certainly opportunity for open question at the end of the presentation. You should see near the bottom of your screen a little chat box with a Q&A logo and accompanying letters there. So if you have any questions, by all means, type it in and we'll make sure we get to everybody. With that, quick note on disclaimers. This presentation is not investment advice. This is not an offer to buy or sell any security. The information contained herein is believed to come from reliable sources, but we cannot make any guarantee of its accuracy. So for a review of our disclaimers, we invite you to go to our website for disclaimers in terms of use and service. So that's investwithwillow.com/disclaimer, or you can go just to our website, investwithwillow.com, scroll all the way to the bottom. You should see it. And with that, I'll turn things back over to Paul and Alexandra to get us started.
Let's. Okay, so next slide. Oh, that's us.
Hey.
So that's Paul and I. For most of you, you should know that we work in tandem on the portfolios. We speak all the time about buys, sells, holds, where we want to go with the portfolio. We literally don't make moves without each other. We find that we both think alike, which is great, but also we both have varying views, which is also great, because then that gives us some time to have some debate as to what's going to be the best option for you and what's not going to be the best option. So us two are going to do this presentation for you today. Everything I talk about, pretty much everything except maybe the broader macro view, I learned from Paul, and then it piqued my interest, and then I started to really do some deeper dives and review. So next slide. One of the things that I want to touch on is I have been in the industry, I think most of you know now, 34 years. It's amazing how time goes by so fast. And I was very fortunate in that I was able to be part of the internet revolution. And I remember back in the 90s, early 90s, when the internet first started, it was a big black box, and there were big names in investments that were saying that, even Nobel Prize winners who said that this wasn't going to be a big deal. The internet wasn't going to affect our lives too much. Of course, many people think it would, but many of the bigger names didn't think it would have quite the impact that it did. One of the things I liked about, I entered into the industry in the 80s, so I was able to really experience the revolution that the internet build out provided for us. And of course, 2-3 decades later, we can all see the net effects. So I liken the experience of what I had on the ground back then to the groundswell that I think is just beginning for cryptocurrencies. So, with this, we really have an investment thesis. We think crypto or digital assets are not just Bitcoin. And this is really important for you to know. Paul and I discussed this earlier. Don't think of it as cryptocurrency. Think of it as crypto or digital assets. So the way we look at it in our minds, the internet build out, the infrastructure that the internet created is really the same way we see the digital assets, the crypto market. It's literally identical. Basically, we already see the impact of the potential of what this can do. And Paul's going to go a little bit into the usefulness of crypto and digital assets and how they currently could be used. One of the things you always in this industry that we always say is follow the money. And if you notice, absolutely follow the money. And more institutions are adopting crypto. More and more institutions are putting money towards building infrastructure on crypto, or let's call it digital assets. I want to take currency out of the equation completely. I want you to look at this like it's a new internet build out, because that's how we see it. That's how we absolutely see it. It can provide additional forms of collateral. Okay, yes. So that's in that regard, it could be viewed as a, let's call it a currency. There's now more arguments, Paul, you can come in at any time, of course. There's more arguments that crypto is taking the place of gold as an inflation hedge. We don't know. That's not something we can determine today, but there is some argument that money's moving out of gold into crypto. And, is it a store of value? To a certain degree, I'm looking at this, I'm just saying this as a veteran in the industry, so to speak. I'm looking at this as the new stock market in some way. Maybe we're at the beginning of a new revolution. The stock market was created well over 100 years ago now, and perhaps we're looking at a completely new market. So only time is going to tell us, but the investment thesis for us more than anything else is this is an infrastructure play to us. This is going to change the face of business, much like the internet did. Paul, you want to add?
Yeah, I think you nailed it. Just to touch a little more on institutional adoption is really what we're starting to see. And that seems to be the phase that we're currently in right now. This is sort of the low hanging fruit that's starting to be picked in this space, where you're seeing major companies, global international companies, dedicating entire internal resources to figuring out how to use this technology and how to integrate it into their businesses, because they can see that, wow, there is a lot of potential here for cost savings, efficiencies, and speed and security. And then what that plays off of too is this idea of collateral, where we're seeing S&P 500 companies adding things like Bitcoin. That's where they are now, but I imagine it will broaden out over time. But they're adding Bitcoin to their balance sheets. Now, why would they do that? It's not just to speculate on the price, but it also provides a company an additional form of collateral. So when they go out to fund a new project or operations or whatever for their business, instead of having to use dollars to do it, they now have the ability to loan against cryptocurrency or digital assets that they have on their balance sheets. And that's one trend that is just starting really this over the past year or two, but more and more companies are sort of hopping on that bandwagon.
Yeah, and the other thing is, you see more and more companies, JP Morgan had an announcement where they're putting more on Ethereum too. So some of the platforms are being built on Ethereum. So this is, this isn't, it's still conceptually being built out, but we think the potential is pretty significant. Next slide. Oh, go ahead, Paul.
Yeah. If you want to go to the next slide, Rachel.
Yeah, let's do that. I find this a really fascinating chart that Paul found. There's the big four accounting firms back when I graduated college. I think it was the big eight, but now we're down to the big four. And what this chart shows you is basically the value of crypto. So you can see in agriculture, they're expecting it to have a medium hit on revenue and a significant hit on cost, basically lowering costs. You see that big round blue circle there.
The circles measure potential impact by blockchain technology, right?
And then you see the social impact is significant. It's, you fast down to financial services, you see the same type of thing, a decent impact. Automotive, you see a decent impact. Healthcare, you see a decent impact on revenue, and then it's certainly on cost. So when a big four company studies things like this, that means we really need to pay attention, because McKinsey is not a lightweight in their, in their management consulting arm. So
and so we're all on the same page here. We're not just talking about Bitcoin's impact on these industries. This is the technology that enables Bitcoin, that technology, or a distributed ledger technology, which we'll get into in a little bit, how the impact of that actual technology. And that's really where we're seeing The investment case and what gets us really excited is that this technology has the potential to unlock all sorts of, as this chart shows, social impact, cost impact, revenue impacts across the board for industry.
Yeah, in all industries. So, yep, this is big. Next slide.
Okay.
This is it.
So,
This is crypto.
right, don't want to get, too much in the weeds here, but it's important to set some basic definitions so we're all talking about the same thing and have a basic understanding of what we're doing here.
And the other thing I just want to point out is we're going to do another presentation at another point that gets into this information in more detail for those of you that like to be a little bit more analytical and have more detail. So we're just going to skim the surface now.
Right, but at its surface, what is a ledger? It's just a record that keeps track of something. What is a digital ledger or distributed ledger? Instead of having a ledger where a company might have this ledger that they keep a record of all their transactions and who owns what and all the activity that happens in that business, they have complete control over that. As opposed to a distributed ledger where it's not one entity that controls that ledger, it's an entire network of computers that's distributed all around the world. So the major difference there is that on a single entity-backed ledger, you have to place your trust in that one entity or in that company that they're doing it right, that they're recording everything appropriately, they're not making any changes. And also you trust them that they are going to live, whatever information's recorded, that you'll actually get back whatever you put in, right? As opposed to a distributed ledger where you don't need to trust one individual, it's the entire network. So the entire network is agreeing that the data on it is in fact correct. So they can much more easily point out and say, hey, this one piece or computer that's talking to this ledger is giving us information that doesn't match everyone else. So they must be trying to cheat in some way. So they cut them out and it doesn't get added to the ledger, right? You can go to the next slide. And why that's important, right? Here's a way to sort of visually see that, where you have a centralized system, or in this case, a centralized ledger where all the different inputs feed into that one center point. And that one center point is what is necessary for that ledger to exist and for all those endpoints to get the information that they need. As opposed to
basically one hub in the middle, so that diagram all the way, whoever's controlling the screen, if you could show the the hub and spoke, the sent over to the left. Yeah,
I think I have an annotate option here. Bear with me just a moment while I maneuver the technicals. All right, hub and spoke is this first visual.
That's okay. We're good. Keep going, Paul.
Yep. And then a distributed system, you can see the difference where all the way on the right, if one of those points failed, nothing really happens to the network as a whole, as opposed to on the left in the centralized one, if that middle point fails, every single person connected to it is out. And then you have that sort of decentralized system in the middle, which is a mix of the two. So it's important to grasp and understand these, and then to see how a ledger run on one of these systems theoretically works. Right? So
really, if we were to argue the point today, we'd say we're more in the middle from what we experience with the web.
Yeah, the internet is a good example of that middle point where, if a website goes down, it doesn't impact the entirety of the internet. But if a service provider like Amazon Web Services or something was to go down, it would take a big chunk of it out, but it would still have some resiliency and there would still be some pieces of it functioning, right? As opposed to where ultimately we're going is this distributed network where one of those points, which could ultimately be something like, in my example, the Amazon Web Services order went down, it does not impact the whole, right, in a significant way. So,
might it be helpful just for a moment for anybody attending that may not have participated in our last year's webinar on cryptocurrency, just to quickly give a high level of how the ledger term and really what that means correlates to digital assets at large.
Ah,
Yeah.
Well, that's a great
Thank-
point
thank you.
to touch on.
Yep, yep.
Right. So how it correlates to digital assets at large, right? So you have these things called ledgers. Actually, if we go to 2 slides from now, I do touch on that. So,
Okay.
but
Do we-
we'll get there. Yeah.
Okay.
Yeah, we'll get there. Let's go here first.
Yep.
Okay.
So why would you want to use a distributed ledger? And this is part of the thesis for why we believe this is going to be such a ubiquitous and big thing over the coming decade. And while not everything happens on a ledger, every single part of our economy touches a ledger at some point, right? Whether that's global trade and commerce, all of accounting is based on ledger systems. The settlement of assets and who owns what all touch ledger systems. Every bit of a supply chain, from when it's extracted from the ground to when it gets manufactured and built into something, and then even recycled or thrown away, that all touches a ledger somewhere too. And then, of course, financial systems and financial assets and how money transfers around the world. Those are all based off of ledger systems.
Yeah,
Now,
think good old fashioned title searches, trade date plus, 2 now when we settle a trade, these are all touching ledgers.
right. And all of these systems, right, they work fine today for the most part. They have their inefficiencies, right? So when I go to, as an example, when I go to send somebody money through Venmo or PayPal or something, it seems pretty seamless and easy, where I push send, it leaves my account, it shows up in somebody else's. But that pathway actually touches about 4 or 5 different intermediaries along the way. And each one of those intermediaries adds cost and reduces speed. So even though it shows instantly on your balance that it went down or up, those funds don't actually settle until days later, which is a really highly inefficient process overall. So that's just a really small aspect of, instead of this massive runaround that these simple transactions have to go through, for me to simply send you something, here's a way to basically cut all of that out. And
Highly
that's
inefficient. I just have to laugh. Okay. I don't know how many people are on this call who know highly inefficient. We all used paper when we started in the industry. So it's just so funny to hear you say highly inefficient, but it is. I get it in the modern.
Well, from where it was a great step forward to where we are today. I mean, I'm not trying to discredit
No, I think it's great.
past history or anything, but as technology moves in leaps and bounds, and this ultimately is playing out to be that next leap forward. And the reason why is because if you can do something 1,000 times faster or more efficient than you could in the past, you don't just do the things you used to do in the past faster, you start to do new things too. And it introduces all these new ideas and innovations and technology. And that's really where we're headed with all of this. So next slide.
With all this speed, does that mean we get to take longer vacations or no?
I hope so. That would be great. So a little background on what a distributed ledger is and how it really ties into cryptocurrencies, right? So the first generation DLT, or distributed ledger technology, was this idea of a distributed ledger. And on that ledger, the only asset that you have is a cryptocurrency. And so the first really example of this, I mean, there were some trials before, but the first example that gained adoption was Bitcoin, right? Where you have a ledger system, the Bitcoin network, and then a cryptocurrency, Bitcoin, that operates on that network that moves back and forth. And so here's this idea where now you have money or a store of value that you can verifiably, securely send from A to B, or one party to the next, without the need to trust a third party or any intermediary. So this is a huge, huge change to how business or anything has been done in the past. The next generation of that was when developers learned that you could find ways to put data on a blockchain. So you're not just sending a simple token back and forth, but you're actually sending data back and forth. And data could represent all sorts of things. And so in this example, we call it property. So now you can send property back and forth and keep a record of property, all different kinds of property or data on a blockchain or distributed ledger. And the term blockchain and distributed ledger are really one and the same, just so everybody's aware. And now you can do that with Bitcoin too. That's kind of how Bitcoin went from this idea of money to now you can also do money and data or money and property. Then the third generation distributed ledger came out, and this is basically what Ethereum is, where you can have your ledger that transacts a token. In Ethereum's case, it's the ETH token. You can send data back and forth, but on top of that, you can also put contracts or programmable code. So some people call this stuff programmable money, because you can set a whole list of stipulations on what happens if XYZ, then this contract will execute and funds will move, or tokens will move from one address to the next. And then where we are today is now into this fourth generation. And these are all sort of built on top of each other, where you have everything I've said before, plus marketplaces. And what that enables now is for basically, I mean, full democratization of almost any asset you can think of. It gives us the ability to literally, and this is a wonderful example I love to use just to show how in-depth you can get. You can put a tracer molecule in an atom, or in a cluster of, say, copper atoms or something, and that tracer molecule could have a piece of code in it that ties back to a blockchain, right? So now you could track that copper bar or that piece of raw material from cradle to grave completely. So you know exactly who mined it, where it was mined from, what it went to be a part of, how that whole life cycle of how it was, and then if it got recycled from there. What that means from a business standpoint is that you get an insane amount of line of sight into your life cycles of your products and all the materials that build them. But really where it's amazing is, as an end user or a consumer, it would allow for us to dictate new terms on our products. So you could say, I only want to buy a car that's made from, that the materials that are in it are from the top rated ESG sustainable mines in the world. And you could know verifiably down to the, little components and pieces of your car that, 90% of it checks the box there, that this vehicle or whatever product you're buying meets your standards on a ESG level, which is amazing to me. So, and that's just one tiny little thing that you can do with this. So how does cryptocurrency tie into this all, right? Cryptocurrencies basically are the tokens that work on these distributed ledgers to move value back and forth, or to move representation of property or digital or real life assets that are converted into a token that is then put on a blockchain, so you can trade these tokens via these marketplaces. And then you can have different contracts on top of that, which allow for derivatives basically to be created. And then from there,
Think credit default swaps.
Yeah, right.
And all kinds of derivatives.
Mm-hmm. I mean, you could have contracts that tie to weather events in the world. So if it rains in a certain area, this contract executes. I mean, the possibilities truly are endless. So what this all ultimately means, and I might be repeating myself, but once you can do something 1,000 times faster or more efficiently, you start to do new things. And that's really what this base layer here is allowing for us to do, is try out new things. One other example I've been reading about is certain athletes are tokenizing their contracts. So basically they take a contract, tokenize it, put it on a blockchain and sell it. And what that does for them is gives them sort of like a cash advance of their contract. So they have a cash advance. But then the owners of the token are all entitled by law, by contract, to a piece of future revenue growth or whatever else that the contract entails. So that's one example. I think the next slide, Rachel.
You ready?
Yep.
Wonderful.
just goes into some different use
Yeah.
cases
Yeah.
for what, everything we've just been talking about, what these distributed ledgers allow for. And, they touch everything from banking to law to insurance, identity. Governments can use them, real estate, media. I mean, there's all sorts of different potential use cases. And we'll probably in the next presentation really go into depth on what's enabled by all of this, because there's some really fascinating things.
Yeah, they're already talking about putting, the vaccine log on the blockchain
Right.
now. Mhm.
All right.
So there's,
Next.
I mean, it's touching everything. So much like, the internet boom of the 90s, it created a lot of efficiencies and it created a lot of job loss in the end, as you know. And recently we've had a lot of uptick in, before COVID, certainly we've had a big uptick in jobs, the first time since the internet boom. So that's got a lot to do with AI and robotics. So eventually, at some point, when this gets fully developed, the potential for efficiencies are going to be significant. So of course, we would expect businesses to morph and change based on that. Mhm.
Big time. Yep. Yep. If you do next slide.
Yeah.
All right. So now I want to deviate a little from what we were talking about to really look at, more of the investment perspective on where are we in this market and what's really happening in this place and why it might make sense to get into it now. So when you look at the market capitalization of the entire cryptocurrency space, it's almost $2 trillion, which in comparison is about the size of Apple. What's also interesting is a metric that's tracked in this space called Bitcoin dominance. And what that says is how much of that total crypto world market cap is actually just Bitcoin and what is the rest. And currently it's at around 55%. So about $1 trillion is Bitcoin and the other $1 trillion is everything else. And then what is everything else? There's about 9,000 different cryptocurrencies out there currently. So many of these are, in our assessment of it, most of these are scams or just vaporware or, hyped up nothings. But there is a good handful of these that are extremely disruptive companies that are tackling some really cool problems and coming up with some very interesting solutions. And that's where we really see the case for investment come up.
Yeah. So, liken this to the internet boom again, there were thousands of companies that came out that were truly not viable. They were just riding the wave. It's the same here. I mean, this isn't something you can throw a dart and just say you're going to make money. There's a lot of scams, in our opinion. So selectivity is really important. Understanding this market is very important.
Right. And then what's interesting about this chart too is when you look at terms of, okay, well, it looks like it's run up a lot. How much further can it really go? To put it in perspective, this is 1/10 the size of gold's market cap. So to us, there's room. All right, next slide. This one I know is a little hard to see, but it's really about adoption and where we are in this cycle. So there's these things called adoption curves that just show over time, how much of a population is using something. And I'm sure we've all seen some really interesting things with like the telephone or television, and they all follow this pattern. And so it's hard to see, and Rachel, maybe you can draw over it, but there's a purple line all the way on the left that curves up.
Yeah. It's got the longer, it's a less steady slope. So
that is total internet users. So all the way on the left, it's like a purple dotted line. Yeah,
right there. Yeah.
And now also remember,
Oops.
also remember this chart is in what's called a logarithmic scale. So it uses a base 10. So it just makes it so you see a much more steady and slow growth as things exponentially get bigger. It's the only way to make them. Otherwise, it would look like these things would look like just like the first half of a parabola where it just goes straight up, right? So if you use a logarithmic version, you can actually see it curve out. And that first one is internet users, okay? And the green line here is Bitcoin users. And this is just one example. And you can see that we are at the point today about where there were about 120 million or so internet users back in 1997, there's about 130 million Bitcoin users as of January of this year. So it's a very similar point as to where we are in terms of adoption for this. So what this tells us is that current trend and how this is projected out over the next 3 to 5 years, this number of users will most likely 10x, or it will increase exponentially as other types of technology have also gained adoption in a very similar fashion. And this shouldn't be any different. All right, next slide. So what does that mean for us when we're looking at this space and looking to invest money in this space? There's 3 core tenets that we try to stick to that to us really have worked out. And that is, one is looking at mind share. And really what we're talking about there is, where are the developer? Where are people actually building? Right? There's tons of projects out there in cryptos that are promising, the sky, but they have nobody actually using their platform or building on their platform. So where we're looking is, what are the established platforms that are out there that actually have communities around them that are thriving and growing and are actively developing on. So that's one place where we tend to look when we're looking to deploy capital here. The next is on agnostic infrastructure, or how can we get different blockchains, which are basically silos, to communicate with each other. And there's projects out there that are working on solving that issue. So you can bring data from the outside world into a blockchain, which could then execute a smart contract, which could then be reliant on another blockchain, which is also tied to another smart contract. So this idea of interoperability really makes it so that we don't see this being as a winner takes all, or that there's only one thing out there that's going to win and dominate the space. No, it's going to be many different players that specialize in different areas. And then it's going to be those infrastructure pieces that connect all of this so everything can communicate with each other. And then the third place we really look for is those useful use cases, or like some of the projects that we've briefly mentioned above, which cryptos are working on those in a viable way that really stand to disrupt legacy systems, or that are finding more efficiencies. And that's where ultimately we want to invest in this space to create a diversified digital asset portfolio. All right, so
Where we go next?
Next slide. So now what we're offering today. We have partnered with some really great groups of people to create a separately managed account that invests specifically in digital assets. So we found the infrastructure on our end to allow for us to do this in addition to our traditional asset management. So we've found Gemini Trust Company, and I'll touch on them actually in the next slide, but they're the custodian. They're a New York trust company that is a registered custodian. They have to follow the exact same security procedures and regulations as our current custodian, Pershing. So from a security standpoint, we feel very comfortable using them because they are under the same exact regulation and reporting rules as our current custodian. Compliant, right? All of our funds that are on this platform, all cash, is FDIC insured up to $250,000. And then Gemini, the exchange we're custodying at, has what they call digital asset insurance, where if they were to get hacked, they have a massive insurance plan on their digital assets. Separate from that, though, going through the Willow Crypto SMA, your funds custodied at Pershing are actually kept on what's called a cold wallet, or an offline air-gapped wallet. So there is literally no way for somebody to hack into that or steal that unless, I don't even know unless what. Their security is phenomenal. And we have links on our website. You can visit willowcrypto.com. You can link to the FAQ there, and it goes into much more depth on all of these different things, from compliance to security and insurance, on all the products. So we've done our due diligence here.
Yeah, it's important also to note that at this point, because it's such a new area, that, you know, the SEC isn't necessarily even considering this an asset. So, you know,
Right.
it doesn't even fall under the same rules and regulations as, you know, what we do on the traditional side of the industry. So we had to take very, I would say, very measured steps to make sure that we were partnering with those companies that we felt most comfortable with, that we felt were taking, you know, we'd like to take a more conservative approach when we're looking at compliance and when we're looking at any kind of vehicle to what we're offering. And we felt that these two partners that we're working with were such companies that would allow us to feel a level of comfort around, you know, their due diligence process. So
Absolutely.
we're trying to follow the most conservative approach that we can take.
Mhm. And so how this works from an onboarding standpoint, if you're a client and you're interested, first we would set up an account with you at Gemini and then link it to your brokerage account with us at Pershing, and you can wire funds directly in and then have it deployed to our digital asset strategy that way. So if it is something you're interested in, please speak with us after the call or shoot us an email and we can let you learn, you know, teach you more on the process and what's involved and more about all the risks and everything that's involved in that. So yeah, the next slide, Rachel, is just our partners, right? So Gemini is the trust company, and then Blockchain is our TAMP, or they're like our record keeper. And that's one more layer that keeps us compliant and keeps it so that we're doing everything as Alexandra was saying, as prudently as possible.
Yeah, keeps us at arm's length, basically, but being still able to manage the money and you know, essentially the same strategy is being followed. You know, Paul and I still look at the technicals of any investment that we put in the portfolio, and then of course with block, you know, with anything in crypto land, we have to make sure fundamentally it makes logical sense for our thesis or for our, you know, our themes, so to speak.
Right.
Yeah.
And then to wrap up, next slide is
Yeah.
just, we have to talk about some of the risks involved here, because as a new asset class, there are a bunch of different risks out there that might not be present in the financial world, but also many of the same risks that are present in the financial world are also present in the digital asset space. So the biggest real concern that we see out there is the regulatory risk, where we just have not had really good guidance from the SEC or FINRA on regulating bodies on how they want to treat all of this stuff. But what we can say is, based on the information that's out there, I have zero expectation that a country like the United States is going to ban any of this or any stuff, anything like that is going to happen. If anything, they're going to start embracing this because
Yeah.
of how much more efficient it makes them in their own processes.
Yeah, I mean, I think there's more and more review with the SEC too, to try to determine how to regulate this specific, and whether even to call it an asset at this point.
Right.
So that's, you know, I want to say that probably all the risks are there. Our volatility risk, I mean, is absolutely, for those of you who follow cryptocurrency, you can see these things have massive whipsaws up and down. That's a big one. Liquidity risk, I mean, we really haven't, we tend to work with things that have pretty good float, I would say, Paul. I mean,
Yeah, we're not trading in, you
mhm.
know, micro cap cryptocurrencies that aren't proven, and, you know, $10,000 could send the price up or down hundreds of percent. So
Yeah, and you know, the way we say this and you know, is we never want to see somebody put their money in that they cannot lose. That's just
Right.
not
Mhm.
advisable whatsoever. What we're doing as a company, I think we said this earlier, I think it was in 2017, when we had all of our employees set up an account, and we gifted them a certain amount of money to go ahead and start working with cryptocurrency so that they had some semblance of understanding. And that was, I don't know, 4 or 5 years ago. So we're doing the same again. We're having our employees be the guinea pigs to open up the accounts with Gemini and to work with Blockchain, and gifting everybody a certain amount of money to go ahead and open their accounts and see how it flies. So, you know, we're putting our money where our mouth is right now as a company.
Right. And one way to look at this too is definitely not this is no get rich quick scheme or anything like that. if you have a long-term time horizon here, 5 to 10 years out, and you can stomach the volatility of seeing massive price swings, then it's our opinion that it's definitely worth having some of your assets exposed to this space. Okay, next slide.
And I think we're ready for questions.
Yes. So
All
you
right.
can always learn more to willowcrypto.com, or feel free to email us info@investwithwillow.com, or give us a call. Always
Yeah.
happy to talk about this stuff.
And we'll do a much more complex presentation
Into the
that
weeds.
gets
Yeah.
into the weeds. Okay, so that you can start to learn a little bit more about how it functions.
Right. We're also in process of building out a resources page on willowcrypto.com that has links to, all sorts of different educational articles or papers and resources that we find extremely valuable. So check it out.
I'm told that my screen is, I'm fading in and out, so I'm gonna go take my video off. Can you hear me now better, everyone?
Yes.
We can still hear you. I was going to make a note. We have a number of current Willow clients on the call with us today. I'll share that the release of Willow Crypto is not exclusively for existing clients. So if you are already working with us, this is certainly something that you have at your disposal. If you are not currently working with us, this is still something that you have at your disposal if you're interested in learning more. And or if you work with another advisor or broker outside of Willow, by all means ask them about us. I know cryptocurrency, digital assets is a very popular topic of conversation and of intrigue for a lot of folks across all different aspects of life. So certainly ask your advisor, and we'd be happy to speak with them one-on-one as well, should that opportunity present or should they want to learn more.
Cool.
All right. And we do have a couple questions come in. First, what is the minimum investment for Willow Crypto?
Did we even state a minimum, Paul?
So we currently don't have
I didn't think so.
a listed minimum. We're trying to see what makes the most sense. But
yeah, we don't have, because it's such a risky asset, we don't have a minimum at this point. And the way we set this up, it's not like our traditional investment management where you're spending time doing, financial planning with us and such. So we have a pretty streamlined process. We really want to open this up to as many people who feel comfortable in the asset class as we can.
yeah, we feel more comfortable to having that conversation with the individual to really determine what an appropriate minimum would be.
Yeah, exactly. So, and then SMA, is separately managed asset, is what that stands for, or separately managed
Account, right? And what that basically is saying is that we manage an account for you at the custodian Gemini in this case. So it's a separate account in your name. One of the major benefits of it is that you own the underlying assets directly. So you have 100% ownership of them, which also has a tax benefit come tax time. You can do tax loss harvesting much easier. So.
The next question we have, how will you be identifying the promising Bitcoins that belong to those 10 areas: banking, healthcare, energy, supply chain, real estate, etc.? These seem to be areas for diversification. Is that correct?
Right. So our process for finding what useful use cases are out there in those specific industries. Right. So again, it comes back to our thesis around mindshare, right? Which one? There's lots of projects out there doing some amazing things in the space, but there's also lots of projects out there that are just talking the talk. So, but not actually producing anything of value. So it's part of our screening process to really dive into what tokens are, number one, available to us via the custodian. And then number two, of those tokens, which ones do we believe have a solid use case, a solid user base, and then potential for growth, really?
Yeah, and which ones have utility, so to speak. And so it wouldn't necessarily be about, industry specific. Right now, we think most crypto that we're seeing has use in many different industries, not one specific one yet at this point, right? Paul, would you agree?
Yeah, yeah,
That's there.
right. And then again, to remember, the entire market cap of this space is $2 trillion. It's still very small. It's still very much the beginning. So we're going to see lots of divergence and convergence happen in the space and within different industries. Right now, we're really looking mostly at what platforms are out there that are enabling all of this stuff, and then what technology pieces are improving scalability and speed and security and interoperability, so that we hold these key infrastructure pieces to crypto, and then along with some of those really useful use cases on top of that. And that's how our portfolio structure in this space ultimately will be.
So I think somebody's asking a question, why Bitcoin is a risk. Is that what you're saying there? Is that what, okay, that's how I'm
That's what I'm
interpreting.
interpreting as well.
Yeah.
And I think a good piggyback to that is, that question is to Bitcoin specifically, why is Bitcoin a risk? But then how
Right.
is Bitcoin in and of itself different from a risk standpoint compared to the SMA?
Right. So to
Okay.
answer the last part first, many of the funds out there or the exchange traded products, they're Bitcoin specific. And that just gives you exposure to that one token, which is ultimately limited in what it can do in its utility. The SMA gives us a much wider option of digital currencies and digital assets to choose from to build the actual digital asset portfolio. So diversification is one of the main risks that we can address with the SMA, as opposed to just jumping into specific funds or exchange traded products.
And I guess, why Bitcoin is a risk, any new asset, well, even if you buy a stock, you're at risk, right?
Yeah.
But this is absolutely a brand new asset, right? So until it's really proven out, then of course it's going to carry a good amount of risk with it, but a risk that we're comfortable with, frankly.
Yeah, there's a website out there. I forget what it's called, but it's like is Bitcoin dead or bitcoinsdead.com or something like that. And it's just every article from 2009 until today that is some agency or some person or notable people too who are saying this thing is dead. And yet here we are today. It's almost $60,000 a coin. So hasn't died yet. If anything, it's still obviously young in its life and it still has a lot to prove, but it looks like that's the direction it's going.
Any other questions, Rach?
I think one is talking about availability. So question on looking at Bitcoin individually and then cryptocurrency as a whole, the relative scarcity of it, the fact that there's a cap basically on available Bitcoin.
Right. And this is going to be unique to each cryptocurrency, basically, where in Bitcoin's case, there is a finite supply. It tops out around 21 million. And after that, there's no more, right? So it would be deflationary in nature. So it is a limited quantity, which, a lot of, especially like gold investors, they really like that idea of here's a scarce asset. There's only so much of it in the world. So if you own a piece of it, great. Which also strengthens the case for collateral that we were talking about earlier too. When you move on to something like Ethereum, currently, I believe it's running at a 4% inflation rate annually, but that's all set to change over the next year as I don't want to get too far into the weeds, but there's an EIP 1559 is coming out over the next several months or to a year that completely changes the tokenomics of Ethereum, where it ultimately becomes deflationary in nature itself, and then caps out around, I think it's 130 so or 120 so million tokens. Now, other tokens can be issued at whatever the contract or the token creator or company creator wants. So many of them are created and they have a finite supply. Others are out there and created and they have no supply limits at all. One of the ones in the news lately is the Dogecoin, or however it's pronounced. Elon Musk was tweeting about it, but it's inflationary by nature, and that's just how it's going to be. And there's other tokens that do. So you really have to look at the crypto asset you're looking at are trying to determine and figure out what is its issuance, what is its float, what is its supply, is it limited, is it inflationary, is it deflationary? But all of those things need to be really researched for each cryptocurrency or each
Yeah.
digital asset, because it's not a blanket statement that just because Bitcoin has a cap of 21 million, that all cryptocurrency has that cap. It's completely unique to each asset.
Yeah, and I think, Paul's pointing to the science of it, the analytical side of it. One of the things you always have to remember, value is only what everybody agrees is value. The world agrees the dollar is value and it's the store value, the US dollar, then it is. It's all about what the collective agrees upon. So if there's wider adoption in Bitcoin, let's say, even with, let's say it has a limited supply, presumably dollars have a limited supply too. There's only a certain amount that's issued every year. So, I mean, as long as the demand for it remains, then, it'll continue to prop up the value. It's only, the collective really is the one that's going to determine what has value here and what doesn't in the end. If nobody believes in any of it, it's all gone. So
Same with the dollar.
same with the dollar, same with Enron, same with WorldCom. I mean, we can go on. So yeah, yep.
Right. And then I'll just touch on this last comment that was sent to us about, let's see, a utility problem, low barriers to entry, there's fraud, theft, no regulation, all bubbles burst. Blockchain is years from being mainstream. Yeah, so again, we're early in this space. There's low barriers to entry because one of the common things I've heard is like, well, why don't I just copy Bitcoin and then I have, millions of Bitcoins and I'm rich. Well, it doesn't work that way. You need a network. You need people to also agree that your copy of it is worth something. Otherwise, it's worthless, right? So without the network effect, there is no way to just copy one of these things and steal value that way. As far as theft goes, what's really interesting is that almost, as far as I know, any of the major cryptocurrencies, they're immutable, meaning you can't change transactions as they happen. So far, the only theft that has happened has been when people send their crypto to a third party, right? Like an exchange or a centralized exchange, and then that exchange gets hacked. It has nothing to do with the underlying cryptocurrency or digital asset and has everything to do with that third party's security. So it's not the technology that is having its security compromised. It's the third party who just doesn't have proper security on storage or they're, not good actors stealing it themselves or something. And then I didn't see what the other pieces to that question were.
Oh, let's see.
Yep, regulation, it's still early, but there are entities out there, entities that governments are working on this. So there was just SEC just issued a risk alert recently on digital assets, which says basically that they accept that it's out there, they accept that it's real. They just want to make sure that people who are in this space are dotting their I's and crossing their T's and being prudent with investor funds. So regulations are coming, they're down the road. It's all part of making this whole thing more robust and resilient.
And I just want to, answer the all bubbles eventually burst. Yes, they do. Yes, they do. And, just like housing bubbles burst, it comes back. Stock bubbles burst, they come back. The question is, this bubble, will it come back? We experienced one in 17, 18, it burst, and then it came back. Question is the viability of this long-term. And again, from our perspective, we're not looking at it as currency. We're looking at it as infrastructure more than anything else. So
yeah, one just on that note, a fun piece is that I remember in 2018, I constantly saw people referencing tulip mania. And if you know the tulip bubble that happened hundreds of years ago, where prices of tulip bulbs went exponentially high and people lost a ton of money trading in that market. And there were lots of comparisons in 2008 of the same thing. But did the tulip mania strike multiple times in a row? I'm not so sure, right? And I think that's one of the major differences here around viability, is that yes, the way that this asset class has been moving is through these hype cycles where there's these insane run-ups and then these insane downdrafts. and then a consolidation period, and it does it all over again. And it seems to just, since Bitcoin's inception anyway, this whole market has tracked that way every few years. So will it come down? Yes, at some point. Could there still be a bunch more upside? Probably. But will that also, experience a significant downdraft too? Most likely. But when you zoom out and look at what this technology can enable over the next decade or so, riding that volatility out might make sense if you have the risk tolerance and risk capacity for it.
And and then I think, the question around blockchain is years from being mainstream. I mean, I would say yes. Things are moving a lot faster now than they were back many years ago, I think, when some of us got in industry in general. What we want to watch for here is how many countries are starting to adopt this as a potential. I mean, I think you heard India is announcing potentially coming up with its own cryptocurrency. You see, something I'd like to look at is how many companies are putting money into the crypto space, like how many, like more and more finance companies you see putting more money in Ethereum, building out their networks on Ethereum. So yeah, is it a long way from being mainstream? I think so, but things are moving a lot faster now than they were many years ago too.
Yeah, and to add, there's something, I think I just read an article, there's 90 plus different countries who are actively exploring this digital currency space and how they can get involved with their own currencies. And so that's huge. And then also to touch on mainstream and how we think about it compared to what's the potential to happen here is we don't know how certain things work, like TCP/IP is the protocol that makes the internet work, right? It just works and it's in the background, but it touches out, it's ubiquitous, right? Some of these blockchains and what they can enable will all be happening on the back end or in the background that make it so when I open my phone and go to a website or send a friend money or go to pay for something at whatever store, the infrastructure behind all of that is run on these distributed ledgers and this crypto technology basically. So it might not seem like it's, as an end user, that it's that present in your life, but really it's going to be the backbone of most of the things we interact with on a daily basis.
I say probably one last comment. I think a couple people might have a question about this is the taxes. And you mentioned in a slide previously, the certain tax benefits or how that might play into crypto management.
Yes. So most cryptocurrency, and there are some that are considered registered securities, but most of them aren't. And those that aren't are treated like property. So from a tax perspective, it can get pretty crazy if you're buying and selling every day and you need to take account of all your tax lots and for multiple trading strategies. Yes, it can get pretty nuts, but it's actually not that different than any day trader out there or anyone using really options contracts too, or trading those on the daily from a tax perspective. So it's viewed as property though. And so if you hold it for a year, it's long-term capital gains tax that gets paid. And that's really it.
And I don't see any more questions on this end.
I think.
All right. Well, we can wrap it up here, about an hour. So good.
Wonderful.
Well, thank you everybody for joining us. If you have any questions, obviously feel free to reach out, give us a call, shoot us an email. Go to our website, willowcrypto.com. You can learn more there. And yeah, we're here to answer your questions. And anyone who's interested, feel free to reach out.
Yeah. Thank you, everyone.
Thank you all. Have a good rest of your afternoon.
All right.
All right.